Good afternoon. This is Ian Campbell with Alpha Capital and Mark L. also with Alpha Capital. We're your financial advisors, and today we're going to be talking about the online enrollment process and also enrolling in the 401k plan and benefits along with that. I want to start with a brief introduction. We both are your financial advisors and are available to each of you to reach out if you have any questions about enrolling or anything financially related to the 401k plan. So please feel free to reach out to us via email or phone with any questions that you have. To start of this, we're going to go through a couple documents and help talk about the decisions that you'll be making around enrolling in the 401k plan. The first document we're going to be looking at will be the online enrollment packet. It is 14 pages in length, really starting on the second page. The second page of the document goes to the website of the provider for that initial step. And then once you see that website link, you'll see, or go to that website, you'll actually see a gray box, and at the top left corner, it'll say online enrollment. You'll click that for the very first time. We do recommend saving this website link or URL because you'll be using that for all future logins with your 401k plan to access the website. Once you've gone to that website, you'll then be prompted to type in the plan password after you hit online enrollment, and then follow the guided steps to completing the enrollment process. I'm going to hop down to page 8 of 14, which is a step-by-step guide of each of the process throughout the online enrollment. The first one, again, being that website, online enrollment, typing in the plan password in all capital letters, and then you'll be prompted to enter in your contact information and setting up a username and password. About halfway through this process, we wanted to just bring up one kind of step. It's right around the 50% mark here, and that'll actually ask you about your investment election and which bucket of money you would like that investment election to be for. This is on the 50% line, and it's asking how you would like that source of money invested. We do recommend that you have one investment philosophy for all of your buckets of money. If you would like to have your other money invested differently, so your company match dollars versus your own contributions invested differently, then that would be where you would pick this here. But in most cases, if not all, the all sources would be our recommendation for you to pick, and that your investments as a whole is how your money is invested. I'm going to hop over to the PDF enrollment form, and the PDF enrollment form is going to be used for those who do not want to participate in the plan as a waiver. We highly recommend everybody do the online enrollment if they can, but if you don't have access and you would like to just print this form out and fill it out as the enrollment, you can do so, but we really would recommend doing the online enrollment. For the first initial form here, it's all contact information and participant information on yourself. The one unique piece is going to be your date of hire. So please double check that and make sure you have that as correct. Towards the bottom of this first page, we'll start talking about the enrollment election. For those who don't want to participate in the plan, this will actually be a waiver, and you'll fill out that top section, select this third option where it says, I elect not to contribute in the retirement plan at this time, and then sign the last page and turn it back in. For those who do want to participate in the 401k plan, you have the pre-tax contribution or the Roth after-tax contribution as options. Whatever you decide today is not set in stone. You can always adjust it, same with your percentage and also your investment choices as well. The difference between pre-tax and after-tax is right in the word. It's when the money is taxed. It's either taxed today at your effective tax rate, or it's taxed in the future when you withdraw the money in retirement. And depending on what your tax bracket is today or what you foresee it to be in the future, you could argue the point would be it might be less today or it might be less in the future. Because we do not know what tax rates are going to be in the future, it is somewhat of a best guess. The argument is that when you're in retirement, you're no longer working or earning that income, so your income drops down, or you're normally in a lower tax bracket. Okay, so hopping over to the how much question, the reason why the 8% and the 10% numbers on these forms is 8% is a national average, 10% would be our recommended number for you to be at or get to. But also for those who maybe are younger, saving at a 10% rate for the entire course of your working career is a great scenario for you to have replaced your income in retirement. So what savings rate should you be at throughout your working career? A lot of studies and research has shown is that 10% is really that number. If you're kind of behind the game, you haven't saved as much as you think would be appropriate right now, then you may need to be at a higher number, even beyond that 10% number. And what I mean by that is just being realistic with your expectations and replacing your lifestyle, what you have now, in retirement. But understand that 10 or 8 may not be in the cards right now. You have full discretion over what you would like to put in, a dollar amount or a percentage as you go through that online enrollment. With that being said, I wanted to discuss the company match benefit for those who do participate in the plan. The company match is what's called a safe harbor match. And the way it works is if you save in your 401k, the company is going to give a match off of what you save. And the equation is it's the first 100%, or sorry, it's 100% on the first 3% that you put in. So it's 100% on the first 3%, and then 50% on the next 2 from 4 to 5. So if you put in 1%, you'll get 1, 2 for 2, 3 for 3. If you put in 4, you'll get 3.5. If you put in 5, you'll get the maximum of 4. So it behooves everybody to at least put in 5% to get the full company match. If you do something less, then you would be leaving money on the table. Now, if you did something like 6, 7, 8, 9, 10, whatever it may be, then you would also still just get that 4%. So the 4 is the maximum that you would receive. And the 8% and the 10% number is, again, from your contributions. It's on your side, not the company side combined. We're going to hop down to the 4th decision around investments. After you've determined pre-tax or Roth or the how much question, investments are the last. The investment decision can be complicated, and we're available to you if you would like to have a greater discussion or want to talk or run things by us. There's about 25 to 30 investment choices that you can pick and choose from, all of which are all institutional grade mutual funds, and they're all top quartile performers in their respective categories. Mark and I's primary role as advisors is to make sure this investment menu is as robust as it possibly can be, but also really good from a performance standpoint as well. We constantly review these every single quarter. If there's a fund that hasn't done well or isn't doing well for consecutive quarters, we'll pull that fund out and replace it with a like-kind fund in that category. If you've got money invested in that one fund, it automatically gets mapped over to the new one. So there's nothing administratively that you or the company would need to do for that investment to change and then your money to change as well. But talking to you about the investment choices, what we've covered so far really doesn't help you decide which one would be appropriate or be best. So Mark and I put together this investment asset allocation guide. This is a helpful tool for those who want to be hands-on or hands-off with their investments. All of the investment choices are listed here on that left-hand column. The category that they represent is in that second column, ticker symbols in the third. And then we've put together 5 different risk tolerance models based off of that equity to fixed income ratio or stocks to bond ratio up at the top. So from a conservative standpoint or conservative risk standpoint, all the way to an aggressive risk standpoint, we've done the math and the homework of what we feel would be a diversified lineup or choices for you in your 401k plan. We tend to see folks that are in their 20s and 30s will be in that aggressive column or that far right one. Folks in their 40s and 50s being in that moderate aggressive column. And then folks in their 60s would be in that moderate column. And then individuals in retirement or through retirement are going to be in that moderate conservative column. And the ask is if you're going to follow one of these columns now and transfer those numbers into the spots that have those funds. So you just, for instance, let's just say we're going to pick the moderate one. We would find the PNC International Equity Fund, put 4% in it, find the Dodge and Cox one, put 6% and go down through that as we're selecting those investments. So the ask is as we come out with these quarterly updates is that you would also pay attention to that as well. We normally will change them once or twice a year, if that, but it is a hands-on approach for you to pick and choose what we feel would be the best case for you. You can change your investments every single day if you wished. There's no cost of going in and out of any of these mutual funds as well. The hands-off or the second option would be to select a target date fund And the way the target date funds work is that you would find out what year it will be when you reach age 65, and that's going to put you into one of these target date ranges in that middle column, and that would be your most appropriate fund. So if you were 65 years old right now or 64, this 2020 fund would be most appropriate for you. If you're 60, it'd probably be this 2025 fund, and so on. So you can identify with your age and how old you'll be when you reach age 65, which would be most appropriate for you. And these work in a very similar fashion where they're aggressive for those who are younger, and then they're more conservative when they're older or nearing retirement. So the ones in blue that I've highlighted are going to be very similar to that aggressive column, which is at 90 to 80% equities. The next four are going to be for those in their working years, later working years, or nearing retirement, and it's going to be that 65-35 model, or that moderate aggressive column. And then ultimately, the ones that are closer to the given year is going to be roughly a 50-50 model, or that moderate column. So they start out aggressive and they de-risk over time, ultimately becoming about a 50-50 portfolio. Our contact information is always on the bottom of this sheet. You're free to reach out to us via phone or email at any time. I'm going to hop back over to the enrollment form. There's a couple final things that we'll talk about and then wrap things up. The beneficiary designation form is important. For those who are not participating or waiving the right to participate at this time, it's not a no forever, but the entry dates into the plan are every 6 months. So it's January and July of every 6 months. So if you waited in July to not participate, then you'd have to wait until the beginning of next year to then start. For the beneficiary form, we do not need them on file. Only the provider would if you have a retirement account or if you're saving. So if you're waiving your right and don't want to participate this time, we don't need you to complete the beneficiary form, just the waiver. For those who are saving, you can put all of this information online as you go through that enrollment process. And the last and final thing is just an account rollover. In the event that you've got an old 401k out there or IRA that's called being neglected, you're not sure what it's invested in, what the fees are, we see it common that individuals will consolidate their funds together so they're not having to keep track of 5 or 6 different statements. They're just keeping track of one at their current employer. And also with that is if you're no longer working for the company and 5 years from now, a year from now, 6 months from now, and you've got monies in the account, you can always roll that money over to a new plan that you're at your new job with or at an IRA either and cash it out as well too. So there's multiple options that you can do from a transfer in and transfer out. If that does apply to you, you'd like to have a little bit greater discussion, feel free to reach out to us. And we can also link you up with the provider retirement plan consultants, which is their logo in that top right corner. There's a gal there, Stephanie Wolf, who's a dedicated rep for your company and can help do that heavy lifting around contacting the old provider, getting a statement, and processing that check distribution over to the new company. So wanted to end there. If there's any questions, feel free to give us a call. Hope everybody has a wonderful rest of their day, and we look forward to talking with each of you if we have a chance to. Take care.